Good evening, Wealth Our Way Nation. What is going on? It is your main man, Charles Tank Harris, the founder and chief visionary officer of the financial literacy platform, Wealth Our Way, where our motto is wealth is not only for the wealthy. It is time to wrap up our three-part series on all things life insurance. I'd like to thank each and every one of you who have checked out the first two episodes and are here now wrapping up the third, and especially each and every person who is right here with me live as I stream across the Wealth Our Way Facebook and YouTube platforms. I welcome you to this Wealth Our Way University special webinar broadcast, and I'm super excited about closing out this three-part series, hopefully having giving you guys a whole new perspective on all things life insurance and opening it up for questions at the end. This particular session is going to be a lot of information. Please have your pens and paper ready, and also hit me in the chat. I just want to remind you guys, when I am doing the slideshow, I can't see the chat, but at the end, I do a Q&A, and I'm just going to go through all the questions at that time. So don't think your question is being ignored. Put your question in the chat as I am going through each slide, because you will know at that point in time what that question was in reference to. With that being said, I am going to slide over to the screen share. You know, it is always an adventure for your man when it comes time to get down with this PowerPoint. So let's make sure I am doing this right. And I go to the custom slideshow, custom one, and I'm in. Now, I am hopeful. Before I make a move or a muscle, I'm going to check the Facebook Wealth Our Way pages on my own phone to make sure that what is supposed to be being seen is currently being seen. And if it is, then I will go from there, because sometimes somebody will text me, let me know it's all good. Either way, I'll take that. I just want to make sure that we are seeing my screen. And here we go. So we are. The screen is set. We are ready to go. All things life insurance presented by your main man, Charles Tank Harris, the visionary officer, chief head honcho of Wealth Our Way. Little disclaimer before we get started. This information provided tonight is solely for educational and entertainment purposes. I'm going to make you laugh a couple times tonight. This information should not be considered sales solicitation, because I don't sell you life insurance. I don't sell you investments. This is a general information session. Consult a licensed professional about your individual situation and needs. So let's get into it, man. We're going to rock and roll tonight. Permanent insurance. There's two chassis for permanent insurance. You will see a lot of sub-variants to these main chassis. In fact, we're going to cover a great many of them tonight, but they basically come down to two main chassis: whole life and universal life. Let's get into these. Whole life insurance. Going to cover the three main variations of whole life insurance. You have what is known as traditional whole life insurance. This is whole life insurance that is priced on your life actuarially until age 100. People live past 100. I was actually researching an author today for children's books, because I read to my kids, and this woman just passed away at 104. So my ex-wife's great grandmother, she lived to 103 or 104. So people actually live to age 100 with this product in place. The product does what's called endowing, meaning no more payments are due. They have a new product out, and when I get to this individual definition, I will elaborate more, but it's called Whole Life to Age 121. When I worked at New York Life, they rolled this product out, and their name for it was Value Whole Life Insurance. I actually own this product myself on one of my loved ones' lives. Then there is Custom Whole Life. Custom Whole Life, so I'm being a little, I guess, biased. People who aren't from New York Life would say I'm being biased right now. Custom Whole Life is a product that New York Life holds a patent for, where they can just dictate the number of years that you have to pay your premium, and that premiums are no longer due after that. Other companies have come out with similar products They call theirs limited pay whole life. So if you see a limited pay whole life, it's basically a variation of custom, whereas they were able to get a limited pay designation for a 10-year or a 20-year or pay till age 65. But custom whole life, you could make it 11 years. I used to do a lot of custom whole life business, and when I get there to that slide, I'll explain why. So the next slide, we're going to talk about whole life to age 100 traditional whole life insurance. When you get your premium on a whole life policy, there is a portion, it's probably a good time right now to break down what a premium payment consists of. A premium payment will consist of the mortality and expense charge. That is basically the cost of the insurance from the insurance carrier saying, this is how much it costs for our company to assure we will have enough money coming in to cover your life in the event of you dying. There is also a premium tax. So like anything else, insurance is a product that is sold to you. When you buy something, you pay a sales tax. The insurance companies are not paying this sales tax on your behalf. They're going to build it into the premium, and it's called the premium tax. That's going to be very important when we get to the slide on custom whole life, that you understand that every premium payment has mortality and expense in it, premium tax, and then other factors, because when you get to custom whole life, after a certain period of time, you stop paying your premium. The mortality and expense is still present, but the premium tax goes away. So we'll talk about that later. Other components of your premium payment with a permanent policy are the portion of your premium that is allocated to a savings account. I use the term savings account. Other people may call it a sub account, cash value. There's various names for it. So that is all factored into your original premium that you're paying. Now, we've talked about this before, that the premium for a whole life product, apples to a term, will be higher. Why is that? Well, the portion of it that's going to savings is a big part. The fact that the actuaries have to figure out what your mortality and expenses to the company, that they know they're going to pay this death benefit. As I told you yesterday, over 80% of term insurance policies do not pay a death benefit. The insurance companies know to factor that in. They know with a whole life policy, the ratio flips. Over 80% of whole life policies pay a death penalty, pay the death benefit. The ones that don't are because the premiums lapse, and sometimes people cash out their policies prior to passing away. Now, the savings account inside of your whole life policy, it grows in two separate ways. One of the ways is every year you're adding to it on monthly premiums, annual premiums. The other way it grows is the insurance company itself is contributing to that account. And as we talked about the other day with the difference between mutual insurance companies and stock insurance companies, companies declare dividends, and the mutual insurers, with your whole life policy, they are crediting your policy with that dividend. The stock companies credit you in a different way, but both savings accounts, whether you're with a stock company or a mutual company, get payment into the savings account from the insurer. You are able, you are able to take tax-free withdrawals through either surrenders or loans. Let's talk about that for a minute. When you buy a life insurance policy, and it's a whole life policy, you're going to get a dividend every year. You are asked what you want the dividend to do. So you can take your dividend in the form of cash. You can literally have, when the dividend is declared, a check sent to you. You can also take your dividend and use it to purchase what is known as paid up additions to your life insurance policy. This is something that I will cover in Q&A because it's not necessarily complicated, but it deserves its own little section. Paid up additions. If you could imagine your life insurance policy being a brick, and every year your brick receives a dividend based on how big the brick is. When you get that dividend, the insurance company will give you the right to buy a stone, if you could follow my analogy. So now you can think about yourself as having a brick, which is your big policy, and a little stone sitting on top of it, which is a smaller policy. The great thing about it is Every feature your brick has, your stone also has. So at the end of the next year, guess what? When your brick gets its next dividend, the stone also gets a dividend. But just like the analogy I'm showing you, the brick's dividend would be substantially bigger than the stone's dividend. But over the course of years, yes, this brick will have a bunch of stones on its back, which will then have a bunch of pebbles on top of the stones. These stones and pebbles in this illustration are known as paid up additions. They are little teeny life insurance policies with cash value in them with their own death benefit. It is the insurance comparable item to compound interest in investments, if that makes sense. Well, when you decide you want to take money out of your policy, you can ignore touching your brick and you can sell off the stones and the pebbles and get whatever money they're worth. This is called surrendering. You are surrendering what you have as your own to take the cash as opposed. You could also say, nope, leave my stones, my pebbles, and my brick alone and give me a loan, insurance company, against the value of my brick, stone, and pebbles. Now, this is a very interesting topic as well. Although this is called All Things Life Insurance, I'll be honest, I did leave some topics out because they in and of themselves get very confusing and are beyond what the majority of my audience will need to know when they buy life insurance. But this is something that you should know, because I'm actually in a situation right now where I'm working with a client. We are interviewing insurance companies, and the one insurance company, they're pretending to be neutral, but they're not really neutral. They are biased toward one particular company. And I can see it because I worked for their competitor for 7 years and I see the bias. When I worked in New York Life, we had a bunch of marketing material that would tell you why Guardian, Mass Mutual, Northwestern, why they were second rate. But all of those other companies, they have their own marketing material to tell you why New York Life is second rate. It all really is true. That's the confusing part. When they show you the article, what they're saying is true. But like we do when we make an argument, they're looking at the best lens for their product. So one of the knocks on some of the mutual insurance companies is how they lend people their money. Some insurance companies lend what is known at a fixed rate. Others lend at a variable rate, which means it goes up and down. More importantly, when you get your dividend, if you are at some whole life insurance policies owned by a mutual company, your dividend will not be negatively affected by the fact that you've taken a loan out. At other companies, they take into consideration that a loan is outstanding and they give you a smaller dividend as a result. So that is called the difference between direct recognition and non-direct recognition. We can talk about it in the Q&A if you want to know more, but I didn't cover it in the slides other than what I said now. The death benefit on whole life insurance policies can increase. Just go back to the example that I gave you of the brick, stone, pebble. Those little small policies have their own death benefit to them. So every year, if you bought a $500,000 death benefit, you may see at the end of a year, it's $500,322. And then one day, 20 years down the road, it could be $705,000 is your death benefit. And you're like, wow, I only bought a $500,000 policy. Look at the growth. The growth is coming from the paid up additions. Another thing that you can use your dividend for is called premium offset. When that means is that your dividend has become so big that it is bigger than the premium you have to pay yourself, you can now put your policy on cruise control and let the dividend make the payments. When I used to sell whole life insurance, I would illustrate the year at which they would have enough money in their policy to never have to pay it again, if the dividend remained the same. That's very important. These are based on hypothetical illustrations. So sometimes interest rates change, the business climate changes, and the illustration is not all that it was purported to be when you started. Whole life to age 121, value whole life. What do you think off the top makes this product different? Well, it's the fact that they are stretching out your age period from 100 to 121. If they are stretching out the time in which you get to have your premium payments amortized for your mortality and expense and every other cost, you're going to have a lower premium, apples to apple, than a traditional whole life policy. Same person gets quoted one price for a whole life policy, they will get quoted a lower premium price for a value policy. But let's not, we have a nature as people to want to just say, oh, that's a great, sign me up for it. We have to realize that with every pro, there's probably a con. And here's one of the cons of value whole life. The cash value, which is something that is very important to people who are buying whole life insurance, the cash value accumulates slower in a value whole life product than it does in a traditional whole life product. And that should make sense. The premium is lower. I've already told you that a portion of the premium contributes to the cash value account. Well, if you're putting a lower premium in, that means you have a lower contribution to the cash value. It should grow slower. This is a product that is ideal for people who are older in age, who are 50, 55, 60 even. And they say, hey, I'm going to have an estate tax issue, or I just want some, whole life that'll never go away and maybe, build cash value in case I live a very long time. But I'm not trying to pay $5,000 a month for life insurance because I've waited to this age. Value whole life shows them a way to buy whole life, get all the benefits of whole life at a lower price point. Custom whole life. I even did different colors on this slide because this is the one that I wanted to spend a little time with, just showing you the differences between, basically all we're doing is looking at the other end of value whole life. So if you had these all on a chart, whole life would be in the middle, value whole life would be to the left as its cheaper younger sister, and custom whole life would be the older sister out there with diamonds and pearls on. This is the flagship product of a lot of insurance companies, because this is not only set up to grow cash value as fast as humanly possible. This is set up for a lot of people who have, Jim Harbaugh comes to mind, the coach of Michigan. When they do split dollar compensation packages or employee compensation packages, this is a product that often gets used. I used to use it a great deal with professional athletes. My professional athlete client would come to me with a new 7-year contract. I would set them up with a custom whole life policy that took maybe 3% of the income they were going to make from this new contract and paid it into a custom whole life product for 7 years. The amount of money that would accumulate once year 7 ended until this player turned 45, let's say, that money would allow them to take out a tax-free stream of income well into their 60s that exceeded the premium that they put in. I tell people all the time, whole life insurance is one of the best options for high net worth people because it avoids taxation, and taxes are your biggest hurdle to wealth building in this country. So this product allows you to set the number of years you want to pay and then never pay again. Now, if you're paying attention, I just told you on the previous slide that whole life insurance will grow a dividend to a point where it'll allow you to use the dividend instead of sending in cash to pay your premium. So you might say to yourself, well, Tank, why is custom whole life and whole life any different if I'm going to get to a point in my whole life policy where I don't have to pay my premium? Here's the difference. In your custom whole life policy, it is guaranteed that you never have to pay another payment. It is literally built into the contract. On that whole life example I gave you, you just happen to receive enough dividends to cover the cost of your insurance. This cost is still there. Every year, this premium needs to be paid. You're just getting in enough money to pay it, so you don't have to write it out of your pocket. In this policy, the premium's not even due. Like, this has a contractual obligation to stop at year 7, year 11, year 16, whenever you set it to stop. And that makes a huge difference, because if we go back to what I told you about premium taxes, when you get to year 10 here, you're not paying premium tax in year 11. On the whole life policy, you are still paying a premium tax every year. You're just not physically seeing it, so to speak, because the dividend is covering it for you. That means this product, which doesn't have to use its dividend to pay future premiums or pay future taxes, the cash value grows very robustly in these policies. I use this in my personal investment portfolio as a replacement for my cash allocation, and I recommend it to my clients because it reduces. There's actually a study that was shown that having whole life insurance from certain carriers with great ratings reduces the risk of your investment portfolio when all combined together. It actually makes your whole portfolio perform higher than the efficient frontier. Whew. Let's get into the, I always pause when I talk about universal life insurance. So universal life insurance gets a very, very bad rap. I'm going to tell you why universal life insurance gets a very bad rap. The first reason is it's not the most simplest product to understand. That makes it problematic for two main reasons. The first reason is you guys are not very bright. It's just going to say what it is. I can't see my audience right now, so y'all may all have just turned off right then. But I mean that jokingly. Here's the thing. We all do what it is we do for a living, and we're good at that. When I used to work with professional athletes, I can count on, I don't have enough fingers and toes to count the number of times people asked me how stupid professional athletes were. And I was the main one to tell them, professional athletes are not stupid. Professional athletes, some of them are actually brilliant. And I'm not talking about the ones that you hear about being Rhodes Scholars. I'm talking about the average pro athlete, the average collegiate athlete. What makes them appear stupid is that they are very focused on one element of life, and that is their profession that makes them millions of dollars. So they're not paying attention. I will give you an example of when Tank looks stupid. Technology. I can't handle. The minute I start getting into instruction number 3 on anything technical, my mind shuts off. I don't want to hear about it anymore. And I'm sure there's someone who says, man, that guy's dumb, but I'm brilliant. So the same thing with you guys. I know that the average person who's not in financial services is not getting themselves well-versed on a deep level on all things universal life. The minute people like myself or salesmen start talking to you about the various features and the different premium methods and all of this, your eyes glaze over and you don't want to hear anymore. You appear to be dumb. You're not. This is just something that's not your expertise, which is why you're here, and I applaud you for that. With that being said, this product requires full attention when you are interested in buying it. This is a complex product. However, I will stay on my position of there is no such thing as a bad financial instrument. There are only bad financial marriages. This product exists in its various forms, which I will cover, because for a specific swath of the population, these products are the perfect answer for their situation. Unfortunately, the second reason they're so problematic comes into play, which is the salespeople. I hate to speak ill of salespeople because I'm still a salesperson, just not of products. And I sold these products for a very long time. But unfortunately, the salespeople themselves don't understand these products sometimes. Secondly, their motivation is to just put you in the product, not often matching up whether it's good for you or not. And then thirdly, a lot of turnover happens in financial services. And by the time you call back to get some answers about your product, that person's gone. So there's a lot of bad marriages made with universal life insurance because it really is an awesome product. It is the most flexible of all life insurance products. And we're about to get into that flexibility, into the details of this product. However, this product is the most litigated of all insurance products. Universal life insurance, people sue insurance companies and the people who sell the product more than term and whole life combined because they feel wronged. At the end of the day, they're sitting in front of an arbitration panel or a lawyer if they're fortunate enough to get out of arbitration. And they're sitting there explaining, hey, this salesperson did not do what was in my best interest. They lied to me. They told me one thing and gave me another thing. And because this product is difficult to follow, people are easily duped. So buyer beware with universal life insurance. Do your homework. Hit up your man at Wealth Our Way, who will give you unfettered advice. So the 3 products that you will hear the most of from Universal Life are straight chassis guaranteed universal life insurance, variable universal life insurance, and indexed universal life insurance. And we're going to go through each one of these now. Guaranteed universal life insurance. So This is a hybrid of term insurance and whole life insurance. That is the best way for me to visually explain this to you. Every year, your mortality and expense portion of your premium is priced like term insurance for that year to cover your life. Now, if you don't recall from sessions 1 and 2, I'm going to give you a quick refresher. Term insurance, the insurance company has to figure out what does it cost to insure a 33-year-old woman of select preferred health at age 33. There's a cost associated with that. They put that as your mortality and expense part of your premium. At 34, that cost goes up because I told you before, every year you age, you're more expensive to insure. If you bought yearly convertible term, you saw that happening because every year your price went up. Why did it go up? It went up by the cost to increasingly share your expense and mortality with the insurance company. In whole life, what they do is they forecast out to an older age what it costs to insure you, and they put a huge pad over your current cost so that if you unfortunately pass the next year, that'll pull in with other risks and they'll be covered. But more importantly, over time, you will pay a fair amount of what it costs to cover you because they've overpriced it in the beginning. Universal Life does not overprice it in the beginning. Now, here's the trick. Here's the part that causes a lot of lawsuits. I walk into your house and I want to sell you term insurance because you're 30 years old. You have about $100 to $150 a month to cover all of your life insurance needs. And you have 2 young children. You have a mortgage. You make $80,000 a year, and you want to make sure that income is replaced at least through the time your young children get and go through college or your mortgage. And I'm telling you, the best situation for you is term insurance because you can buy a lot of death benefit for this budget you have. But you've been listening to someone who told you, nope, term insurance is a ripoff. It never pays. You want something that's going to build cash value. You need a permanent product. So you tell me, throw term out the window. Okay, cool. I'm happy because as the salesperson, the higher the premium, the higher the commission. So now I show you whole life insurance. The exact same products I was telling you. I already told you needed $1 million worth of insurance. So I show you $1 million of whole life. You see the cost and you put your kids to bed so you can start cussing. It's just crazy, crazy high. Then I say, okay, listen, you want this $1 million of permanent coverage. You want cash value in your policy, but your budget doesn't quite afford this. I have something that can also give you cash value and be permanent, but cost 40% less than this. And you're like, why didn't you show me that first? And I pull out Guaranteed Universal Life. Now, there is a lot of truth to what I just said, but there's a lot of information that still needs to be said. One of those things is when you buy Guaranteed Universal Life, a portion of your premium goes into the savings account, just like it did in the whole life policy. Here comes the difference. In a Guaranteed Universal Life, you're not going to get dividends hitting your policy. You're going to get a credited interest rate from the carrier. And that will depend on what you agree upon in your contract. There is a floor minimum rate, and then there is an illustrated rate. And that interest crediting is what you're going to get in your policy. The problem is this. I told you all the benefits of whole life at your table, how you could take money out in retirement and enjoy it and not affect your policy at all. Then I told you Guaranteed Universal Life acts the same way. And I tell you, yes, it has a savings account. So I walk out of your living room, sale made, and you're thinking you own something that when you turn 65 and retire, you can go into, take cash out of the savings account and be all for the better. That is the misnomer of this product. Because the cost to insure you goes up every year in this product, the older you get, the more expensive this product gets. The older you get, the more premium you should be paying. But you've been paying the same premium your whole time. And I'm going to get into it in a minute, the multiple premium options that you have with this product. You've been paying what is known as the target premium from the beginning of time. Well, the target premium will make this policy stay in effect forever should you do two things. Always pay it and not take the cash value out of the policy. Because what is happening at some point as you age, the target premium is now not enough money to cover what you should be paying for this policy. The insurance company says, no problem, we're not panicking. We knew this would happen. We're going into your savings bucket and offsetting the cost that you're short on. Now, if you're trying to go in that bucket, guess what's going to happen when you're 71 years old? There's not enough money in the bucket for this increased premium that you're not paying because you've been paying this target premium. You're going to get a letter from the insurance company saying your cash account is deficient to make your next payment. If you want to keep this policy from lapsing, you have to pay a higher premium payment than what you've been paying for the last 25, 30 years. It's going to freak you out and you're going to call your attorney. And that's why this product is the most litigated product that the insurance industry sells. Once again, though, if this salesperson would have explained that to you, hey, this is a way to keep permanent insurance in place. There is a savings account that grows, but you don't need to ever think about that as your money. That's going to be the insurance company's money to pay your pay your higher premium when you get older. If it's explained, you give the buyer the choice of saying, okay, I understand that. I like that. Let's go with it. But misleading is what normally happens with products that people don't understand very well. As I said, all universal life products, we're going to start with guaranteed. They all have multiple premium options. This is another feature that makes these products amazing. And like I said, a good product. Whole life, not so much. Whole life doesn't have multiple premium options. The premium is the premium. And you try not paying it for a little while and see what happens to your policy. Bye-bye policy, it's lapsed for lack of payment. When you have a guaranteed universal life premium, a policy, they normally have a minimum premium payment, what is known as a modal premium payment, what is known as a target premium payment, and what is known as a MEC premium payment. This would be a great time to tell you what MEC means. So the insurance industry, the financial services industry for that matter, loves acronyms. MEC is short for Modified Endowment Contract. Why is that important? Life insurance has a lot of tax-free benefits. The death benefit is income tax-free. You can take loans and surrenders and dividends tax-free because you are following a certain formula that the government has made insurance companies follow about the amount of cash that can go into a policy on any given year. But this is the first thing I explain to people who argue with me that permanent life insurance is a ripoff. Permanent life insurance is not a ripoff. In fact, wealthy people, they make every effort possible to put more money into their policy than is required by the premium. They put additional money in. Why? Because they wanted to grow tax-free. Well, the government got hip to that. And they set up a formula that says, for every dollar you put into a life insurance policy, a certain percentage of life insurance needs to be bought. Yeah, you can put some extra cash in, but you can't go over this ratio. If you go over this ratio, we realize you are not buying this insurance policy for the purposes of insurance. You're buying it to hide cash and grow it tax-free. We're going to take away all the tax-free benefits of your policy. We are going to make it, instead of being a life insurance policy, into a modified endowment contract. In the industry, we say it's going to MEC or it's MECing. So every cash value policy always shows you what the MEC premium is. What the premium is that if you exceed this, you're going to mess your policy up. So you know, hey, if I want to throw some extra cash in, I can, but make sure I don't exceed the MEC premium. On the guaranteed universal life or all universal life chassis, they show you 4 different premiums. I'm going to repeat them. Minimum, modal, target, MEC. Modal is the mode in which you pay. Monthly, quarterly, semi-annually, or annually. Oftentimes, the modal and the target can be the same, but sometimes they're not. The target can be higher. With all of this being said, when you buy a policy, the salesperson and the contract itself will tell you it is the target premium that you need to concern yourself with. If you always pay the target and you don't deplete the cash value, this policy will never, never, ever lapse. However, times get tough. You may have a $750 target premium payment, but a $200 minimum premium payment. And you get laid off, COVID happens, anything happens. You call the insurance company up and say, you don't need to call them up. You just send in the minimum premium. In the early years of your policy, this is not going to be a problem. Your policy is growing and the cash value is getting credited and your cost of insurance is rather low. You can pay the minimum for months, maybe years. But at some point, the piper comes calling and you got to go back to paying the target. Not only do you have to go back to paying the target, you should pay a little over the target for where you were short for those months. But that flexibility is very welcome in people's lives when they go in and out of certain income situations, to be able to slow down premiums, increase premiums as they see fit. Whole life term does not offer that type of flexibility. Variable universal life insurance. So everything that I just told you about guaranteed universal life insurance is the exact same for variable universal life insurance. Here is the difference. I told you that the cash savings sub, whatever you want to call it, account in a universal life policy gets an interest rate credited to it from the insurance company. A variable universal life policy gets something in addition. So they still have a guaranteed minimum rate that they will be credited, but a portion of their premium goes into investment sub-accounts, which are mutual funds. And they buy the S&P 500, the EFA index, the Russell 1000, the Fidelity Met flagship fund, whatever. They are literally growing investments inside of your life insurance policy. You know, they say financial services is more of an art than a science, and I agree, because you can ask 20 different professionals and they'll have varying opinions on products. This is not one of my favorite products. I believe that my life insurance and my investments should be riding on two different horses. And when I use life insurance as part of my asset mix or my asset portfolio, I am looking at it as cash. I'm not looking at it as my stock or bond portion of my portfolio. As such, I want it to outperform CDs, bankers acceptance, money market rates, but I'm not trying to get 7, 8, 9% inside of my insurance policy, because the exact same thing I was telling you about those multiple premium payments happens here. People start in the bull market like we're in now, seeing all this extra money going into their sub account, and they start to say, well, that's my money. I can take some of it out, or I can stop paying my premiums. And then they turn 65, 70, 71. They hit a bear market and their sub account goes down 30%. And all of a sudden they're getting called and being asked for a payment. And it's just very unstable, in my opinion. Clients have very short-term memory and amnesia almost when it comes to something going wrong and you telling them, oh, I told you that could happen. No, you didn't, is what they say. So the reality is I don't like to utilize this because it's kind of confusing. With that being said, there is one marketing scheme that the industry has come up, which is they call this the rich man's Roth IRA. And what's that mean? Well, the Roth IRA, you've heard me talk about that ad nauseum on 15 Minutes of Finance. And you've definitely heard me say everybody should get one. It's the greatest thing in the world. I do believe that. Unfortunately, they put limitations on it. They limit how much you can put into it, and they limit how much you can make to put money into it. So people sell variable universal life because there is no limit to how much you can put into this, but your investment gets to grow tax deferred. And if you take the money out through loans or surrenders, it actually is tax free to you. So here is a way for you to put money away, grow it in the stock market, and get the money back without paying taxes. The only other place you can do that is the Roth IRA. So they call this the rich man's Roth. Although you don't have to be rich, so to speak, to have it. You just got to make over the income limit. You actually can do this no matter what income limit you make, but there's marketing this to people who make over the limit for the Roth IRA. Ooh, we're at the end, and We saved the best for last. When I say best, this is the most difficult product to understand. However, I had 5 clients that did these products last year because they were perfect for their situation. But each of those clients made at least $600,000 a year. So once again, this is why products get in trouble, because this is a great product for certain people. But for the average Joe and average Jane walking the streets, you might want to steer clear of this one unless you fully understand what's going on. So it too is structured like a GUL. The savings account credit rate is determined by options. So now I got to explain options to you guys. So in the stock market and the bond market, you can buy something the day that you see it, or you can buy the option to buy it later or the option to sell it later. When you are dealing with an indexed universal life insurance policy, the insurance company is buying call options on a certain index. That's why it's called indexed universal life insurance. So for the purposes of this example, the only index I'm going to talk about is the S&P 500. But do know that there are a bunch of indexes that they're allowed to buy. But I'm going to use the S&P 500. They say you're going to take your premium, take a portion of it, and buy a bunch of call options on the S&P 500. Now you have to understand what buying a call option means. When you buy a call option on something, you are buying the right to buy it at a certain price sometime in the future. So let's just say, for argument's sake, the S&P 500 is currently worth $1,000. You can pay $1 today for the right to buy the S&P 500 at $1,100 next year. If the S&P 500 actually goes up to $1,500, you buy it for $1,100, immediately sell it for $1,500, and you've made a lot of money. If the S&P 500 does not go up, you just don't use your option. You let it expire, what's called expired worthless. So there is no downside to you buying the option except for one thing: the price you paid for the option. That's what you can lose. If you paid $1 for this option and it expires worthless, you wasted $1, so to speak. But you can't lose more than that dollar. That is why this product is marketed the way it is. So now I'm going to get into the marketing of it. This product is marketed to people who know they need more growth than they can get in a bank account, more growth than they can get in a whole life policy. They want stock market returns. They want stock market upside. But they are petrified at years like 2008, 2001, 1987. They don't want the major crashes and corrections to affect them financially. So Mr. Salesperson comes into your living room and says, how about a life insurance policy that the cash account grows by a portion of how much the stock market goes up? And more importantly, no matter how bad the stock market performs, you never go below zero in your account. You never have a down year. That sounds terrific, you would say. You got to look a little further behind the curtain. Now, what that person said is 100% true. Let's be clear. But what did I say? I said you get a portion of the upside. There in and of itself is a limiting factor. So when you buy an IUL, there are normally caps on how much interest they will credit to you in a given year. It may be a cap that is a predetermined interest number. Like they may say, no matter what the market did, the most we're crediting your account is 9%. Or they'll say 120% participation, and they'll pay you a percentage of that participation number. It can get quite complicated. But in any event, you're not getting more than 9%, 10%, 8%, whatever the cap is. If you have listened to 15 Minutes of Finance, and if you've studied the stock market at all, you know that the stock market does not go straight up in a straight line. The stock market goes up and down, up and down, up and down. And I'm always telling you, you got to be in it to win it. The up years are what make you your money, of course. The down years, they hurt, but they come and they're followed by up years. Now you are setting yourself up to give away upside potential. Now, the thing about the upside is it's unlimited. It can go up to an infinite number. The downside can only go to nothing. It can go bankrupt. So right there, if I had a choice between capping my downside or capping my upside, I don't know if I want to cap something and give away unlimited potential. With that being said, yes, it's great to not have any down years in your crediting. But did we not remember that we are always going to have a down year if the market doesn't make any money because we had to pay for the option? And in this product, that's built into your premium and it's an expense. So these products tend to be more expensive than any other insurance product. But when sold to the proper person, they make all the difference in the world because the person doesn't need the money in the short term. Over time, these tend to outperform whole life insurance policies because they tend to average about 4%, 3.5% over the course of your ownership, whole life. These tend to average about 5.15%, 5.25%. And, you know, I've shown you guys in other episodes of 15 Minutes of Finance that a 1% difference over 30 years can be a lot of money. But because of all the extremely complicated parts of this policy, of all the life insurance products, so UL in and of itself is the most litigated. Index Universal Life is the most litigated of the UL. So it by far is the product that people sue over the most. With that being said, we are at the end. I did keep it to 45 minutes. I'm a G. I'm very good at this stuff. I hope you guys understand and appreciate this free knowledge you're getting is top flight. But I'm going to stop the screen share because you should already have my information and come out here and start talking to you good people about the Q&A. So let's go here. Let's minimize this. Let's go here. And we are back. So let's take a look at some of the questions that are here and do Q&A. Thank you all for attending. I see Sister Lindsay, Sister Tashawana, Brother Arion, Sister Tamiko. Oh, everybody's in here. I love it. So let's talk about these questions. I applied for term with New York Life, waiting to hear back. Stay on them. Make sure they're doing right by you. Can you deposit or fund the guaranteed universal life, the universal whole life policy? So your two questions in there. So are we talking about the guaranteed universal life or a whole life? Because it's not a guaranteed universal whole life, but you can put extra money into either policy. So to answer your question, you can put extra money into a guaranteed universal life policy, and you can put extra money into a whole life policy. The benefit of the guaranteed universal life policy is that you are paying less money to have that policy. See, so what I normally do is I tell people you want term insurance because it's cheap, but you also want insurance that's actually going to be around when you die. And a lot of times term is not going to be. So I would tell somebody, get a guaranteed universal life policy. Now, like I told you with the return of premium in term, they have a return of premium function in universal life products. At the end of the day, you want a policy mix. You want short-term death benefit for your catastrophic expense years handled by term. You want your death benefit when you're 80, 90, or 100 to come from a guaranteed universal life policy. You want your cash value that you're going to use in retirement to come either from a whole life policy or an IUL. That's the way you should be looking at these policies. So I want to move to the second question. Are you taxed for investments in the sub-accounts? No, you're not. That's the great thing about those policies, why they compare them to a rich man's Roth IRA. The sub-accounts grow inside of the insurance policy without any taxation. And so long as you withdraw the money from your policy in the acceptable ways through surrender, through a policy loan, or at death, there'll never be tax on that growth of those sub-accounts. Do loans allow it to be taxed? Yeah, and that's the answer. So the answer to your previous question that I just gave was your next question. Yeah, Lindsay, is a lot to know about life insurance. So I didn't even touch on some of the things like riders, and I'll do that now because riders are very okay. What happens when an insurance company is bought out? Great question. Nothing, basically. Nothing to the insurance policy, the policy owner. You really don't need to worry about it. Every insurance policy, as I talked about in segment 1, the insurance companies are backed by their state insurance commission. And just the same way, think about when you're driving. Everybody has driver's insurance, hopefully. There's a portion of your driver's insurance that goes to uninsured motorists. You guys familiar with that, looking at your policies? Uninsured motorists is our responsibility to pay for people who are driving recklessly and don't have coverage, so that our insurance companies don't have to bear the brunt of it alone and possibly go out of business or raise our rates so high that we can't afford insurance. The state insurance commissions are like uninsured motorists to insurance companies. They back insurance companies. When an insurance company becomes insolvent and cannot pay its debt, it goes to the state insurance guarantee committee. Also, when a company is bought out, the new company had to be financially strong enough to make an offer. So you're more likely in a better financial position when your company gets bought out. Anybody else have any? I was talking about riders for a minute. So riders, this is the best way for me to explain a rider. Think about buying a new car and asking what features come on the car. Do you want heated seats? Do you want sunroof? Do you want TVs in the back of the headrest? These additional features in the insurance industry are called riders. And just like a car, some cars have features that come with it standard. Some riders just come with insurance policies and you don't have to pay for them. Other features in the car that you may want upgrades, you got to pay for. Same thing with insurance. One of the biggest riders right now with insurance policies are accelerated death benefits. What does accelerated death benefit mean? It means that you bought a policy that is going to pay somebody a death benefit when you die. However, there are a lot of times where you need money in life still. You have riders in your insurance policies that will accelerate the death benefit so that you can use them. The two major riders that do that are the chronic care rider, and these riders differ in name from company to company, but they're basically chronic care rider, which is you're dying of something. You have, stage 5 liver cancer or something, and you can have a doctor show the insurance company that death is imminent. And yes, you want your kids to get some of that $1 million, but you'd like 200,000 of it right now to go tour Italy before you pass away. You can accelerate your death benefit. The other one, which is probably more useful for the majority of people, is the ADL rider. It's the daily living activities for daily living. There are 6 of them. If you can't perform 2 ADLs, you are deemed to be eligible for long-term care assistance or home health aides and things of that nature. So they sell a rider for insurance policies that will allow you to accelerate a portion of your death benefit into a pool of money that can be used to pay home health aides, nursing homes, assisted living facilities, or the like. So it's a really good feature. Because long-term care insurance has gotten so damn expensive, a lot of times when I'm helping my clients pick out insurance, we're doing a form of insurance planning. Some of the money is going to be coming from their own personal money they know when they get older. Some of the money is going to come from a long-term care policy, but we're probably not going to buy a big enough one to cover all the expense because it's going to be mad pricey. And then the last bucket that we want is a life insurance policy that has a rider that allows us to take some of the money off for long-term care. So, sometimes my clients want to argue with me because they think they're smarter than me, and good luck with that. But I had a client the other day who wanted to tell me she didn't need life insurance because she doesn't have any heirs and she's set with money, and all of that stuff was true. But I was explaining to her the cost of long-term care, and this was a concern of hers. She brought it to my attention. And I said, you can make out cheaper by buying a life insurance policy, bulking up on this particular rider, and having money ready for your long-term care expenses than buying a long-term care policy for the limits you want. And, people aren't used to hearing that type of talk from someone who knows what they're talking about, because guess what I would have just done if I was an actual salesperson? I would have talked myself out of a commission. She wanted to buy a long-term care policy, and I'm telling her, you're going to be spending too much money. Do this instead. And I encounter that a lot in my business where I have to explain to people, hey, look, take the benefit of a person who sold this stuff and who knows this stuff, who now doesn't get paid to sell it, but gets paid to give you advice, lean on my advice. I know what I'm talking about in this area. So you definitely want to buy products. There's also a rider in a lot of insurance products called the waiver of disability, which means that if you become disabled for any stretch of period, your insurance premium is paid by the company and you don't have to pay it. So you don't have to come out your pocket while you're disabled. So my man Devlin showed up to the building. Love it. Thank you for showing. Oh man, you know what? Devlin just came with the monster question. I completely skipped it. Thank you, brother. I completely skipped it. Juvenile life insurance. I talked about this on Thursday of last week, but really funding it with custom whole life or IULs. This is why you do this. When we talk about the fact that a custom whole life insurance policy, so I used to do this product at New York Life. We called it $1 Million Baby. You have a brand. So I did this for a lot of professional athletes. I did it for my high net worth clients who were grandparents and they wanted to do something for their grandkids. These people had a lot of money. So when I give you this example, it'll be like, oh my God, that's for rich people. Know that with the number I'm using, you can break it down to any smaller subset of this number. So I would tell people, you got a brand new baby. Baby's going to go to college at 18 or 19. Let's get an 18-year custom whole life insurance policy, or shorter. Get a 12-year, get a 10-year, whatever floats your boat. Now, fund this policy with the gift amount that you're legally allowed to give without paying taxes on it. And I think it was $15,000 at the time I was doing this illustration. So once again, sounds like a lot of money. That's $1,200 a month. But these are well-off grandparents who had the money. I showed them an illustration where they could put this $15,000 away for 18 years and then take money out in years 19, 20, 21, and 22 to pay $50,000 a year toward college. Now, let the money continue to grow to age 30. Now the child can take $50,000 out at 30 to put down on their first home or pay for their wedding. Then don't touch it again until they're 67. And now at 67, they can take out $2,500 a month for the next 20 years. Grandparents loved that. Anybody, you guys heard my program earlier today about Social Security. I had so many grandparents who were like, oh, my poor grandbaby's not going to have Social Security when they grow older. I said, do you want to give them Social Security right now? I have a plan. And that's what we did. So understand that as a child, insurance is pennies on the dollar. It's never cheaper. If you buy a custom whole life insurance policy, and I'm not saying don't get a 529 plan for your kid. You know, stocks outperform whole life policies all the time. Stocks unencumbered by insurance expenses outperform VULs and IULs too. So a straight 529 plan and index funds, it's the way to go. But I had a client that had over $700,000 in 529 plans amongst his 3 kids in 2008. And he woke up and it was worth $420,000 overnight. And one of the kids needed to go to school. So now we're going to pay a tuition that will never have a chance to come back because of the market. Had we split that money half and half, and for this particular kid, a client, he was a ball player, we did. Had we had some of the money in a whole life policy, now he doesn't have to take from the 529 until it grows back up. He can use the money from the whole life policy. And once again, I'm showing big numbers, saying big numbers. This can happen for anybody on your scale. Instead of $15,000 a year into the policy, put $1,500 a year into the policy. It's $120 for junior or little Miss Junior. And you can grow a fortune for your legacy. I'm all about legacy creation. So any other questions? I don't want to keep you guys past the hour. We're toward the end. Great question, Devlin. I appreciate it. Great question, Tamiko, as well. And Lindsay, let me see. This is why you're such an incredible resource to us. We know you are just advised. Yep. Lindsay, you know, you warm my heart. You're my special friend. So I thank you for the kind words, though, sis. Well, if there are no other questions, I am so happy you guys attended installment 3 of this webinar. This will be a vital question and answer part of the Wow Wealth Contest, which is screaming. So not only did you not pay to be in the webinar, you about to win $200. Like, come on now. We're going to get your money right in 2021 and beyond with Wealth Our Way, because my motto is wealth is not only for the wealthy. I thank you all. I'm Charles Harris. I'm signing out. You guys have a great evening.